Okay, good. So please, we begin with our IPSAS. Okay, so today we are taking IPSAS Note 1. This is IPSAS Note 1. Are you okay? And it's going to be on assets. It's going to be on assets. Now, what is the standard on assets? Are you okay? What are the accounting standard on assets? There's a need for IPSAS board to bring out or come out with standards, okay, that will regulate us, or accounting standard that will guide us so that they'll be able to achieve consistency. Are you okay? There shouldn't be an instance that when you take the financial statement of Nigeria, they have treated inventory in one manner. And when you take the financial statement of Ghana, Ghana too has treated inventory in a different manner. No, there's supposed to be what? Consistency. There's supposed to be oneness, okay? Because you don't know who will go and take the financial statement. Anybody that takes the financial statement should be able to understand it. Are you okay? So therefore, there's an accounting standard on how to treat inventory across the globe. Across the globe. Everywhere you go, there's only one way of treating inventory. So far as the public sector entity uses inventory, if you want to record it on your financial statement, there's only one way of treating that inventory. Are you okay? So that's what we are about to do. The IPSAS standard on inventory. How do you treat inventory? How do you treat inventory? Ladies and gentlemen, you are all welcome on board. So this is IPSAS 12, right? IPSAS 12. Perfect. Good. So let's begin. Inventory. Inventory. I'll take the first one. Inventory. Thank you. Now, in public sector, when you talk about inventory, ladies and gentlemen, it's the same inventory you know. Are you okay? It's the same inventory. Examples of these inventories are ammunitions, consumables, maintenance material, spare parts. Okay, they are all stock. Are you okay? Stock of unused or unissued currency, postal service, they are all not important. Educational, training costs, whatever. Please, inventory is inventory. Any inventory you know. Nobody asks you, give examples of inventory. Are you okay? But then you should know that they are the same inventory. Okay. Now, my question is that how do you record inventory in your books? Okay. How do you record inventory in your books? You know, sometimes there are certain inventories that you have to produce it. Okay. There are certain inventories that the company has to produce it. Do you get it? And there are certain inventories that the company has to go and buy it directly for use. Do you get it? There are certain inventory that the company produces it from scratch. Do you get it? Especially if the company is a manufacturing company. Okay. They'll produce their own inventory, the finished goods, or the final goods that they sell, the finished goods or the final goods that they sell. Let's take Fan Milk Ghana Limited, Fan Milk Ghana Limited. They produce the fan milk themselves. So the fan milk too is an inventory. Is that also? So what is the value? What value do they give to that fan milk that they produce? One sachet of fan milk. What value? How much do they attribute? What is the cost? Are you okay? What is the cost of the fan milk? Because the fan milk is also an inventory, okay? So what is the value? Do you get it? So, or if it is raw material you go and buy, what is the value of the raw material? What amount you put in your book? So if I go and buy a raw material, let's say I go to Kanishu, I buy, let's say, raw material for 20,000. Okay, that's the value cost. And I take TNT of 5,000. Are you okay? And they ask him, what is the value of the inventory? What do I tell them? Do I tell them the value of the inventory is 20,000 or 5,000? Or 25,000? What should be the value of the inventory? Is it 20,000, 5,000, or the entire 25,000? So the value of the inventory. Are you okay? So cost of inventory. So when you want to identify the cost of an inventory, pay attention. If you want to know the cost of an inventory, please, the cost of an inventory is not the cost that you purchase the commodity. No. It is the cost that you purchase the commodity and all other related costs. And all other words related costs. Are you okay? So cost of inventory is the cost of bringing items of inventory to their present location and condition. All costs involved in bringing the inventory to its present location and condition. That will be the cost of the inventory. There's a need for you to know how to know the cost or how to calculate the cost because you are a chartered accountant and you are going to manage that public sector entity. Hence, you tell us the cost of an inventory. Are you okay? Good. So the cost of an inventory includes cost of purchases. Cost of purchases. So the cost of purchase includes purchase price, including import duty, transport, handling cost, any other cost. Okay, like, I mean, any other directly attributable cost, less trade discount or rebates or discount. Discount is the best way. So let's say if you go and buy the commodity for, let's say, 500,000 and I give you a discount of 10%. You buy the commodity for 500,000, I give you a discount of 10%. And ask you, what is the cost of the inventory? Don't tell me it is 500,000. No. You tell me 500,000 less the what? The discount. Are you okay? That's what they're saying. They're saying less any discount or rebate. Rebate is the same as discount. Don't say that, oh, because the cost is 500,000. Therefore, the cost that I'll put in my book is 500,000. No. Once I be giving a discount, less it. If there's any import duty, you bought a commodity from abroad, from China. If they bring the raw material to you, you have to add the import charges. Any charge you incur. Hey, you pass. You put the way you pass, eh? Hey, the way you pass, only those who will follow what I'm saying. We are taking it step by step. Me say, learn unit 4 and unit 5 before today. Those of you who have not done it, I'm giving you up to Sunday. Finish it before Sunday. Okay. Okay, good. So let's proceed. Take it serious. Question 3. Unit 4 and 5 is question 3. Question 3. Okay, good. So let's proceed. So please, we are saying that the cost, no, it involves the purchase price plus any import duty. If you transported the commodity, okay, the transport charges and any other cost related to what? Bringing the commodity to the organization. Good. Costs which are specifically attributed to unit production, such as direct labor, direct expenses, subcontracted work. Are you okay? All direct labor and all those things, you have to add it to the cost of the what? The commodity. Maybe you have to convert the commodity to finished goods. You have to convert the commodity into what? Finished goods. What was the labor cost? What was the labor cost? What were the direct expenses? What were the overhead expenses? Any cost you have to incur, you have to add it. Are you okay? This is how to get a cost of an inventory. Do you get it? Cost that you don't include in the cost. If you want to know the cost of an inventory, expenses that you don't have to include, expenses that you don't have to include in order to arrive at the final cost of an inventory are abnormal waste. Do you know abnormal? Abnormal waste, intentional waste, waste that doesn't make sense. Probably maybe your machine is spoiled, and because of that, there's a lot of wastage. Don't include that abnormal waste as part of the cost of the inventory. That one there, it should be your own operational expenses. Don't add it to the cost of the inventory. Storage cost. If you finish producing the commodity and you want to store the commodity, that one you are done producing the commodity. So therefore, the cost of storage, should not be part of the cost of the inventory. Are you okay? Administrative expenses. Any administrative expenses. Are you okay? Are you not a chartered accountant? It falls under administrative. Don't add those administrative expenses, security and all those things. Don't add it. Are you okay? Selling cost of selling. You do advertisements and all those things. No, those costs. No, don't add it to the cost of the inventory. Foreign exchange difference. Okay, you bought a commodity at this foreign amount. When you enter into a country, the foreign exchange rate has changed. Foreign exchange difference. Don't add it. Interest cost. Interest cost when inventories are purchased with a deferred settlement terms. You go and buy the commodity instead of paying cash, you decided not to pay cash. Okay, that interest that accrues, you don't add it to the cost of the inventory. Are you okay? Please, all these are disallowed costs. Disallowed cost. So the same as PP. Those of you who know PP, the same thing. Okay. Okay, good. We have an example. Yeah. Our first example for the night. So simple. Get your calculators. So we go. It says, example 1. Example 1. Kano Municipal Assembly. Okay. So it says, Kano Municipal Assembly is a manufacturing hub. The cost per unit of an item of inventory is shown on its card as follows. Materials, 30,000 or 30 cedis. Production labor cost, 33 cedis. Production overhead, 12 cedis. General administrative cost, 10 cedis. And marketing cost, 5 cedis. Required. According to IPSAS 12 inventories, what is the value on one completed item of inventory in Kano Municipal Assembly Statement of Financial Position? So solution. So they want to find the value of one completed commodity. They want to know the cost per unit. Is that also good? So cost per inventory or per unit. Okay. The cost, because it's only one. So you have material cost. You have production labor. Is that also production labor? Hey, see, 100,000. Oh, I've worked with thousands. Production labor, 33. Is that also good? We have production overhead. Production overhead cost. Okay, all costs connected or attributable to the what? To the commodity. General administrative cost. This one you don't include. Do you remember? Call that you don't include general administrative expenses. The following cost should be excluded. Should be charged to expenses. This one, general administrative overhead. So we don't include it. So disregard it. Don't include this one. Marketing cost. Don't include marketing cost. Marketing cost is a selling cost. Cost incurred in selling the commodity. Don't include marketing cost. Ladies and gentlemen, the cost per inventory, okay? The cost of inventory is what? Is 30 plus 33 plus this. Answer, 70 what? 5. So that's that. Here this will be the cost per inventory. Okay, good. This is what we show as the goods and services. This will be the goods and services that was used for the year. Okay, good. Let's proceed. Example 2. I didn't heard you. This is an accounting standard. I'm teaching you. So from today going, you as an accounting chartered accountant, you should be able to know how to know the cost of an inventory. Are you okay? So example 2. I think the way I'm writing this thing, I'm writing it too big. Okay, I'll try and reduce it. I'm writing too big. Or is there anything? Okay, good. Let's go. Example 2. Kano Municipal operates a small workshop that produces school desk for public basic schools. The cost per unit of a completed desk is as follows. Cost of delivery, 21,000. Materials cost, 800,000. Storage of finished goods, 10,000. Irrecoverable purchases, 9,000. Labor cost, 350,000. Required. According to IPSAS 12 inventory, what is the value of one completed school desk to be recognized in Kano municipality's financial statement? What is the cost of each desk? So cost per desk. So we go, cost of delivery. Remember, cost of delivery is not fast. Cost of delivery to what? Customers. If it was cost of delivery to the factory, cost of delivery to the company, fine. That one, we know we have delivered the raw materials. Cost of delivery of raw materials. But this one is cost of delivery to customers. It means the final product. And it is a selling cost. It is not part. What you see here? If you want to know the cost of the inventory that you used, it shouldn't be part. You should not include cost of delivery. Do you get it? If it is cost of delivery of raw material, that one is fine. 2, material cost. Of course, material cost. Material cost, 21,000. Material cost. Storage of finished goods. Storage of finished goods. Now, when they finish the goods and they store it, storage of finished goods, remember, storage of finished goods should not be part of the cost of inventory. Do you remember? We said it. Storage of finished storage cost should not be part. It should be excluded. It should be an expense. Are you okay? So that one is not part of it. Irrecoverable purchases taxes. Taxes. Purchases taxes. Taxes is import duty. If you imported it, if you bought it in the country to, when you bought it, you paid a duty. Are you okay? Irrecoverable purchase taxes. Irrecoverable purchase taxes. So that one is how much? 9,000. Hey, my eyes. So this 21,000. I've used the wrong figure. Can you see that? Hey, my eyes. So I think I've used this. This one we don't use it, so let me cancel it. This one I've used it. Labor cost. Labor cost. So labor cost, you have to include it. Okay. The cost of the inventory. Are you okay? Good. So this becomes the what? How much each commodity will cost. How much each commodity will cost. Oh, yes, that's the cost incurred in producing each commodity. The cost incurred in producing each commodity. Answer, please. Answer. 1159000. Thank you, Mr. Joseph. Odun. Answer here. This one. Wait. Material cost is 800,000. Exactly what I wrote. This I wrote 800,000 now. Material cost 800,000. So I'm done. Are you okay? That is so simple. Who's anything cry? This one, apple, this one, nothing difficult. Can you see that? This one, apple. So that's that. So we are done with this, right? So let's go to recognition and measurement of inventory. Recognition and measurement of inventory. We are done. Now, we are coming to, this is when we are value the inventory, okay? And the code that we put in our books, okay? Now, recognition and measurement. Recognition and measurement. Recognition and measurement. Now, inventory is recognized. Inventory is recognized at the reporting date in the statement of financial position as a current asset, right? Inventory at the reporting date. Reporting date is the date, the reporting date is the day that they are doing the what? They are preparing the financial statement, the end of the year, the date that they're preparing the financial statement, okay? So any inventory remained at the end of the year, any inventory remained at the end of the year, where do we put it? Any inventory remained at the end of the year, we put it in a what? Under current asset. At the end of the year, every inventory remained is put under what? Current assets. Do you get it? And that is the what? Statement of financial position. Is that also? Statement of financial position. And all inventories used in the year, the inventories used in the year, inventories you consumed in the year, we put it under what? We treat it as expense, okay? Specifically, goods and services. Specifically, treat it under goods and services in the what? Statement of financial performance. Are you okay? So all inventories that we use in a year is treated under what? Goods and services. Do you get it? So in most questions, I mean the balance sheet, the preparation of financial statement you have been solving, they will tell you that the opening stock, they'll tell you that opening stock is, let's say, 1,000. They'll tell you opening stock of inventory is 1,000. That's how they write it. They'll say first inventory. They'll say inventory. Okay. They'll write something like this: 1st January 2025. Telling you that this is the opening stock. You get it? Opening stock. Let's say if they say opening stock is 1,000. Can you see that? And Definitely in the year, the company has to buy more inventories. Definitely in the course of the year, the company has to buy more inventories. So they'll say that will be purchases. Is that also? That will be purchases. That will be purchases. Let's say they bought 20,000 worth of inventory for the current year. Are you okay? So what does it mean? It means that the company is how much inventory the company working with. The company is working with 21,000 worth of inventory. The company is using 21,000 worth of inventory to produce the goods and services. The company is using 21,000 worth of goods and service inventory to produce the goods and services. Are you okay? So if I ask you how much inventory will go into the statement of financial performance, you tell me 21,000. Is that also? I mean, how much inventory will go into goods and services? How much inventory will you post into goods and services? It is 21,000. Is that also? This is the inventory they are using for the year. But then if the question gives you that, if the question should tell you that, oh, at the end of the year, we still have 5,000 worth of inventory remaining. At the end of the year, we have 5,000 worth of inventory remaining. What it means is that the company did not use all the 21,000 inventory. They still left some. So if you ask you how much inventory did they use for the year, you told me that, oh, they used 16,000. How did you get the 16,000? It is this 21,000 less closing stock. And when you let the closing stock from it, automatically, what do you get? You get what? You get 16,000. So in effect, if you do this under goods and services, in effect, you are telling us that the company used 16,000 inventory. That is why we tell you that when you are preparing financial statement, the closing stock will always less it from goods and services. Because it is in the goods and services that you did the you added the opening stock. It is the goods and services that you add the purchases for the year. So therefore, any closing stock, they are going less it, so that automatically you will be able to know the value of inventory that they used for the year. Are you okay? So this closing stock, this is what will go into the balance sheet. So they're saying that what? Any inventory, any inventory available at the reporting date. Reporting date is at the end of the year. When you're preparing the financial statement, that's the reporting date. Any inventory available at the reporting date, will be treated in the what? Statement of financial position. As a what? As current assets. Are you okay? That's how you should treat it. Then any inventory used for the year, we should treat it in a statement of financial performance as an expense, goods and services. Do you get it? So in essence, for essence purposes, they will tell you the opening stock. They will tell you the purchases. You have to know that the one in the footnote is the closing stock. So the closing stock, less it from these two, the opening stock and the purchases, and automatically what you get will be your the inventory that they use for the year. But just that because you don't get a difference, you just less it and you're done. But that's what it actually means. If you understand the concept, I'm trying to tell you something. If you understand the concept of what I'm saying, raise your hand, give me a handshake. Like what I'm saying, the reason for how we treat the inventory. The reason for how you treat the inventory, yes. Say and then that's what we have all been doing. Okay. That I said the closing stock, let's say from goods and services, then send it to the statement of financial position, right? This is the meaning. You remember I told you that when we get that, we'll explain it. That's why I've explained. Okay. However, let's proceed. So this is how you recognize the inventory, okay? You recognize it as an expense and also as a current asset. Do you get it? Good. Now let's go to the measurement. This is what you all know. Measurement of inventory. We are now going to measurement. Measurement of inventory. You love measurement. You love measurement. Measurement of inventory. Ladies and gentlemen, inventory is measured at the end of the year. How do you measure the inventory? Inventory is measured at the lower of cost. That's the historical cost versus net realizable value if inventory is for sale. If the company, they are selling the inventory, like the question I gave you, a certain university, and they said that the textbooks, they are selling it. If they are selling the textbook at the end of the year, if you want to know the closing stock, are you okay? It will be the lower of the cost, the historical cost of the textbooks available versus how much you get if you should sell it. And the net realizable value and the historical cost, the lower. Or if the inventory is not for sale, this is a public sector. NADMO. You know NADMO? NADMO has a lot of inventory, but guess what? It's not for sale. NADMO has a lot of inventory, but guess what? The inventories are not what? For sale. Uh, they are for distribution in ordinary course or in the normal course of business. They are for distribution. Do you get it? Free. So not bono, it will be wrong for you to say you are comparing the lower of the cost of the inventory versus the net. It will be wrong because they're not going to sell it. So why net realizable value? Rather, for a company NADMO, it will be better for you to compare the lower of cost versus the replacement cost versus the what? The replacement cost. Are you okay? Or a company that buys stationery, a company that buys raw material for use in the company. They are not going to sell the raw material. So that wants you to be lower of cost versus how much it will cost you to replace it. Versus how much it will cost you to replace it. That is the meaning of replacement cost. Okay. So inventory is measured between the lower of cost and the net realizable value if inventory is for sale, or the lower of cost versus what? The replacement cost if inventory is not what? For sale, but rather for distribution or for use in the company. Are you okay? Good. If acquired through non-exchange transaction, the cost is the fair value. Sometimes you can get an inventory, but you didn't buy it with your money. Somebody dashed it to you. As a typical example is bus stop boys. Bus stop boys. A lot of the inventories they are using, okay, they didn't buy it with their own money. It was given to them as a gift. So for bus stop boys, at the end of the year, how do they know the value of that inventory? Because they didn't buy it, so they don't know how much it cost. For them to even go and compare the cost versus something, they don't know how much it cost. So for a company like bus stop boys, you know bus stop boys, right? How do they value that inventory? And you're saying that if it is given to you as a gift, the value will be the fair market value. The value, you go to the market and ask, oh, this same asset, no, how much is it costing? Or this same inventory that somebody has given to us as a gift, how much is it costing? That same inventory. They receive a lot of protective clothing and others. Are you okay? All those things, no, they have to go to the market and ask, this same thing, how much is it costing the market? Are you okay? So that they can use it. That's the fair market price. How much is it costing? The fairly. How much is it costing the market? That will be the value that they will use in their book. Ladies and gentlemen, this brings us to the end of inventory. This brings us to the end of inventory. I'm on mute, all of you. If you have any question, ask. Please, you have a question on your screen right now. Example 3, measurement of inventory. Please, I'm giving you 3 minutes to finish this. Okay. Start work, all of you. Start work, all of you, please. 3 minutes. Hey, you'll be under IPSAS there, you'll be doing a lot of questions. So, hey, you'll be doing a whole lot of questions. So be ready, okay? Start work, all of you. Start work, start work. Required. Requirements. Required. A. In accordance with IPSAS 12, determine the amount which the medical supply should be recognized in a statement of financial position. II. Explain how the subsequent consumption of these medical supplies should be accounted for. Lastly, briefly justify why NRV is not considered relevant in this case. Start work. 2 minutes more. Two minutes more, please. 1 minute more, please. Oh, it is the same thing we've been doing. No, this is how the question will actually come. They intentionally put the question this way. So if you don't take care, you think he by the same thing. Okay, it's time. It's time. Let's go to it. It's time. Let's resume. Okay, good. So, example 3. It says, at the end of 2023 financial year, Kwalibu Teaching Hospital reported medical supplies in 8 central stores. The following information was provided. Historical cost, 2 million. Current replacement cost, 1,800,000. Net realizable value, 1,700,000. The supplies are not held for sale, but are to be used in delivery health services to patients in the coming year. Required. In accordance with IPSAS 12 inventory, determine the amount at which the medical supplies should be recognized in the statement of financial position. At what amount should the inventory be recognized in the statement of financial position? So recognition. At the end of the year, remember, they have given the historical cost, they have given the replacement cost, and they have given the net realizable value. And they made a statement here that what? The supplies are not held for sale. If it is not for sale, then automatically the net realizable value goes out. It's not for sale, right? So therefore, you'll be left with 2 options, which is the historical cost and the replacement cost. So you ask yourself, which of these 2 is the lower? Ladies and gentlemen, in accordance with in accordance, determine the amount. Therefore, the amount to be recognized in the statement of financial position is. So this will be the closing inventory. Is that also? That is so, right? Perfect. B. Now explain how the subsequent consumption of these medical supplies should be accounted for in the hospital financial statement. So subsequently, the inventory remained is 1,800,000. So subsequently, that is next year. Subsequent means next year because this is the end of the year, right? So the end of the year 2024, 2023, you have to recognize 1,800,000. This a closing inventory. Hence, it should go to what? Current assets. In 2024, okay, this 1,800,000 will be used in 2024. Okay. So subsequently, that is in the next year, if you use the 1,800,000, 1,800,000 will be treated as expense. Is that also specifically goods next year? If you don't use it, they are fine. But if you should use it, then the 1,800,000 will be expense because that is the inventory at the beginning of the year. Are you okay? So when you use it, it will go to goods and services. Do you get it? If you use it, it will go to what? Goods and services. Are you okay? Now, next one, briefly justify why the net realizable value is not considered relevant. That one, I'll leave it to you. Why is it not considered relevant? Because the inventory is not for sale. The inventory is not for sale. Good. So now mark against what you did. So this is the solution. of course, the solution they will explain, okay? But this is the most important thing. Therefore, the medical supply should be recognized in the statement of financial position as 1,800,000. So correct. Okay, here they'll give you the three and they'll do the comparison. Are you okay? That one you already know how to do it. Now, subsequently, when the medical supplies are issued for use, the amount of 1,800,000 is recognized as an expense. If the 1,800,000 is used in the next year, the 1,800,000 is issued for use, then to recognize as an expense. But if not all the 1,800,000 is issued and they leave some out, what they left out, that one will go to a statement of financial position. True of us, justification, because it's not held for sale. Because net NRV is applied when inventories are held for sale. Saying the hospital's medical supplies are intended for internal use in service delivery and not for sale, the appropriate measurement base is current replacement cost and not NRV. Good. Here we I see hands up. Yes, Beatrice, unmute yourself. Quick one.
Yes, please. I'm a little confused. You know, in the statement of financial performance, we would have done 2 million minus 1.8 and then we would have gotten 200,000. And that is what we will recognize in the at the use of goods and services.
Repeat what you said, please.
The statement of financial performance, we would have done the 200,000 minus the 1.8, which would give us 2 million minus 1.8, which would give us 200,000. And that's what we.
If you're giving the cost of the inventory and you are giving replacement cost, do you deduct the replacement cost from the historical cost?
So which ones have we been deducting?
We don't deduct anything. We just choose. Are you okay? So if I give you the historic, if under inventory, okay, you have the cost of inventory is 2 million, and they tell you that the replacement cost is 1 million, whilst the net realizable value is how much? 1,600,000. In an exam situation, if you tell you that the cost is 2 million, the replacement cost is 1,800,000, and the net realizable value is 1,700,000. Madam, how do you treat it? They've given a footnote. They say, the inventory, the cost is 2 million. The current replacement cost is 1.8 million, and the net realizable value is 1.7 million. Madam, please, in this situation, you tell me, how do you treat it in your own way? Okay, please come on that. In your own way, please. Hello, madam. Oh, you're muted. No, I just want to find out. I just want to test something, okay? Inventory, and inventory, if you get this, how do you treat it? Yes. If I give you, and they tell that, the inventory is not for sale. They tell that the inventory is not for sale. They've added it, okay? Supplies are not held for sale. How do you treat it?
So, because it's not for sale, the net realizable value is not added. But then you choose the lowest value. Perfect. And because it's under the footnote, we have to treat it twice. So we take it to goods and services and then we put it into brackets.
Perfect. So you see, you don't deduct it. You carry the full amount. Go and supply from goods and services. And then when you finish, that same amount, what do you do?
We take it to the statement of financial position.
Exactly. Perfect. So exactly what you are saying. Are you okay? And I'm telling you, we are not doing the standard. I'm telling you now here that the closing stock of inventory, send it to the balance sheet or the statement of financial position as a closing stock. Okay, so I'm asking you, this here, the closing stock, what do you do? The requirement, he said that what? In accordance with IPSAS 12, determine the amount at which the medical supply should recognize in the statement of financial position. What amount should they send to the balance sheet? That's the question. Madam, will answer it for me. What amount should they send to the balance sheet?
Please, they will send the lower of the two, which is the 1.8.
Which is for how much?
1,800,000.
So okay. I send 1,800,000 full stop.
My problem was the goods and services side, but I think
that one is not captured here. Who said that one? We are not talking about. It's the requirement you are following. Do you get it? Forget
Yes.
balance sheet. Forget what we did in the preparation of financial statement. Not forget it entirely. I mean, don't focus on that one. Follow the requirements. Follow what the requirement is telling you. Please, are you okay?
Yes, please.
Let's follow the requirement. Thank you so much. It's not that you are confused. You are not confused. Brofo. Brofo is the order of the day. Good. Second one to say that what? Explain how the subsequent consumption of these medicals, subsequently, how should this inventory be treated? And I'm saying that because the 1,800,000 is the closing stock, when we enter into the next year, the 1,800,000 will be my opening stock. It means it will be my stock available. And the answer is that if the 1,800,000 is issued for use, then 1,800,000 should be treated as goods and services because they have been used. Are you okay? In other words, how do you treat opening stock? Opening stock is added to goods and services. Opening stock of inventory is added to goods and services, right? Because if this 1,800,000 is the closing stock for last year, then become the opening stock in the next year, and it should be treated under what? Goods and what? Services. Simple like that. Are you okay? What it means is that inventory used in the current year is treated as goods and services. Inventory used in the current year is treated as goods and services. Are you okay? Thank you so much for the rest also. And the last one says that what? Justify. The last one says what? Justify. Esther, ask a question. Madam Esther. Richmond, ask a question. Richmond,
Hello, sir. Hello,
okay,
sir.
Esther, coming.
What was it say? If inventory, subsequently the one I had everything, but with the B, mine was subsequently the 1,800,000 we treated as in the current assets.
Oh, subsequently, not just going forward, it will no more be in the balance sheet. It was because it was at the end of the year. That's why we sent it to the balance sheet. Now going forward, when you use it, it's going to goods and services. Two of us, you expense it because you have used it subsequently. You are going to use it in the next year. Madam, two of us.
Sure.
You see how IC can trade the thing. Subsequently, you are going to use it. So once you use it, you say the A part is saying that at the end of the year, right? How should you treat it? Now, subsequently means from next year going, this 1,800,000, you're going to use it. So it will no more be 1,800,000. You're going to use it in the subsequent years and to be treated under goods and services. Thank you.
So not current assets.
No. Current asset is wrong. Oh.
Okay. Okay, I chose current assets. I wrote current assets. That's why.
Okay. One thing to have noticed about students, Esther, don't force my force. So I should get your answer should be correct. No, okay. Learn from so you learn, so that next time you know how to do about it. Perfect. Good. Richmond, quick one.
Yes, please, it's not your question actually, but it seems today your PDF or your slides, you have made it a little bit small, and we are finding very difficult to read. So if you can zoom it a little bit,
Okay. You mean my questions? Is that the case?
Yes, please.
Okay, very well. Okay, thank you. But then I will give it to you to try before we all do it. Start work, all of you. Do this. Hey, okay, good. So let's do this together. All of you start work. So this is the question. So during okay, so please start work, all of you. Do only A, please, because of, let me see, I want to see if I can zoom in more for our brothers and sisters using mobile phones. Yes, so I think it's okay now. You have 2 minutes. You are stopping at 7:46. 7:46. As at 31st December 2024, details of the closing inventory were as follows. Inventory type, office consumable. Historical cost, current cost, net realizable value. Fertilizer for sale. They say, requirement. In accordance with IPSAS, in accordance with IPSAS 12 inventories, compute the value of closing inventory to be presented in the statement of financial position. Closing inventory to be presented in the statement of financial what? Position. So this is the inventory they bought. Are you okay? And this is the inventory. Some will be confused because someone tip full, right? This is the inventory they bought. We don't care about the inventories they bought in a year. What you are interested in is the closing stock. What you are interested in is the what? The cost of the closing inventory. The cost of the closing inventory, okay? And they gave us that this is the cost. When it comes to office consumable, this is the cost of the closing inventory. 700,000. When it comes to fertilizer for sale, this is the closing inventory. And they gave us the current cost, that's the replacement cost. And they give us the net realizable value, okay? Now, this is clear. Office consumable. They don't have to tell you that it is for use in organization. They said consumable. Office what? Consumable. And they said fertilizer for sale. You should know that it's for sale, right? Good. So closing inventory. A. Closing inventory will be, please, this is consumable. Consumable means that what? It will be used in the organization. True or false? True. Consumable means it will be used in the what? In the organization. So therefore, please, consumable, therefore it will be used. Hence, we will not sell it. So cancel the net realizable value. Net realizable value is out. Okay, good. So you say office consumable. So for office consumable, it is what? 500,000. Then when you take fertilizer, please, fertilizer is for sale. It's for sale. So once it's for sale, it's the lower between the cost and net realizable value. So you cancel the current cost. Are you okay? So the lower between these two is 500,000. You take this. You take this. Ladies and gentlemen, this becomes the closing stock. So if you ask me, what value should you put in a statement of financial position? This is what will be taken to the statement of financial position. So is the two, okay? Because these are their inventories for the year. If the inventory is only 500,000, it's for the two. So it will be 500 plus 500. Are you okay? Don't worry, we are learning. So if you go to only 500, know that is the two next time. B, show how the consumption of these inventories will be reflected in the statement of financial performance. How the consumption of these inventories will be reflected in the statement of financial performance. It's simple. So in the statement of financial performance, B, they are asking you. So you see, here they didn't say subsequently, okay? They said in the statement of financial performance for 2020, for 31st December. So in the statement of financial performance, it will go under expenses. It will treat it under expense. So under expense, it will go under what? Goods and services. Is that also? So under goods and services, we have what? We have the office consumables. Is that also? We have office consumables. They're asking you how you treat this in the statement of financial performance. We have office consumables. $4,100,000. We have fertilizer for sale. $3,900,000. Are you okay? So this is the total inventory used for the year. This is the total inventory used for the year. Total inventory used for the year. How much? 8 million. Less closing stock. Which is 1 million. Ladies and gentlemen, this is how it will be treated in the statement of financial performance. So the question says that what? Show how the consumption of inventory will be reflected. So this is the inventory consumed for the year. Or let me say inventory for the year. Inventory for the year. If I say consumed, some is for sale. Inventory for the year. Inventory that was used for the year. Now, briefly explain why the measurement basis differ for office consumable and fertilizer. Why is the measurement basis? Okay, good. So, it differs because one is for sale and one is not for sale. If it is for sale, the principle says that you use the low of cost and the net realizable value. If it's for sale, if it's not for sale, the principle says that you should use the lower of cost and the replacement cost. Is that not so? That is so. Ladies and gentlemen, Agbena. So that's why the principles differ. Maybe. Do you get it? Show how the consumption of these inventories will be reflected in the statement of financial performance. This is the consumption. So it means how much this one was consumed. 7 million inventory was consumed. Okay, the opening stock, add purchases. But here they didn't give us any opening stock. They just gave us the purchases. So these are the purchases for a year. Less the closing stock. This tells us the inventory that was used for the year. That's it. So in statement of financial performance, this is the inventory that will capture that was used for the year. Are you okay? This is the inventory that will capture that was used for the year. It will be treated as an expense, right? Is that okay? Expense under goods and services. Someone is asking, say, will you not rather treat it under inventory? Please, inventory is under goods and services. Do you get it? If you can go and do your inventory computation somewhere and bring it under goods and services. It's the same thing. Okay, good. In public sector, inventory, whatever, is still under goods and services. In the public sector, it is the private sector that is sent to cost of sales. Over here, we don't have anything like cost of sales. We treat everything under goods and services. Okay, good. That is that. We are done with inventory. I take some few questions, then we move on to the next one. Asao, this is an examinable question. This is an ICA question. This one is an ICA question. ICA question. Yo. Asa, simple like that. Nothing difficult. Ellen, ask a question, please.
Oh.
Yes, please.
So how can you treat the, what about the balance sheet? Financial position.
Repeat what you said, please.
I'm saying that the IPSAS that we have done now, if they said that we should treat it at the financial position, how will you
okay, but do you understand this one? Treating it as an expense.
Yeah, I understood it. I just joined, but I understood.
Okay, good. Then you see, if they say you treat it as a statement of financial position, how much will you send there? I'm asking you, how much will you send to a statement of financial position?
So I'll take the closing stock. That is the 1 million.
Exactly. So that's what you have here. See, you're good though. You are good, Papa. See, closing inventory. So this is it. The first one is a statement of financial position. Are you okay? They said that what? In accordance with IPSAS 12, compute the value of closing inventory in the statement of financial position. So this is it. This 1 million is what we treated. So you see,
okay.
To current assets, right? So this one, see, 1 million.
Right. Thank you very much.
Should be sent to statement of financial position.
Okay.
Are you okay? Under current assets. Current assets. Okay, good. Yes, Paulina, please unmute yourself.
Sir,
Madam.
Please, you mentioned a non-exchange transaction, but I didn't get how you said it to be treated.
But do you understand this one?
Yes, I understand it.
Don't worry, we will come to that. Okay, don't worry.
Oh.
Thank you. Yes.
Sir, please. Can you throw more light on this thing? Why is that the storage cost is not part of the inventory cost?
Madam, are you the one that said you just joined? Are you the one?
Yes.
No wonder. So you hold on. Why? I will explain. Hold on. Bye. Good. Mr. Joseph, please unmute yourself.
Sir, mine too will take you back some more, but it's just about the initial cost, the one we did earlier. irrecoverable purchase tax that we added. So
Yes.
supposing the question mentioned that it is recoverable, that means we won't add.
Yes, you will not add. Okay.
Okay.
You will not add.
Okay.
But in fact, you add all taxes. So all taxes related to the inventory, you add it. Tax is tax. Okay.
But they stated that it is irrecoverable.
Irrecoverable, yes.
But I'm saying that what if they mention that it is recoverable, or maybe the tax can be refunded to them?
Oh, that one is that one is there. But then there's no recoverable that doesn't have an irrecoverable aspect. Are you okay? There's no recoverable tax that doesn't have a recoverable. All taxes. No, there's no recoverable tax that doesn't have an irrecoverable aspect. That's what I want to say. Are you okay? In fact, for example, purposes, all taxes are included. Include all taxes. You don't expect to see recoverable before you add a tax. Are you okay? For example, purpose, any tax be added to the cost of the inventory. Do you get it? For example, purpose, don't wait to see irrecoverable or recoverable before you add it. What you are saying? That's why I was using an example like import duty. Okay, any tax be included. Thank you very much. Good. So please, one at a time. Madam Ellen, you're asking, say, why are we not including the security cost, the marketing cost? Please, that is what the principle says. The principle or the standard says that do not include abnormal waste, do not include security or storage cost. In fact, this is storage cost. Do not include administrative overhead. Administrative overhead could include security cost. Are you okay? Do not include selling cost. Cost of selling the raw material or the finished goods. Cost of selling. Do not include it if you are selling, unless you are bringing it into your company. But then the cost that you are incurring, if you are selling it, do not include it. It's a principle. I will note you. When I give it to you, you understand. Are you okay? Good. Madam Beatrice, you are the last question. Please ask a question.
Please, I'm a little confused. You see, the first one, this was what I was talking about, that we put it into bracket. But then the first one, we didn't do it that way. So I want to know, what would you see in the question that will let you know that you have to do it this way? Or you have to just put the 500 there and that's it?
Look at the first requirement. The first requirement says that what? In accordance with IPSAS 12, determine the amount at which medical supplies should be recognized in the statement of financial position. They're asking you how much should be sent to the statement of financial position. No. Madam, please, are you okay?
No, I'm talking about the second one, the subsequent one.
Okay, let's go. It says, explain how the subsequent consumption. Please, when it says subsequent consumption, what does it mean?
You said that it means that the following year.
In America is the question. Subsequent means the next. Are you okay? Subsequently, yes. When you are consuming the inventory. Now, what's the value of the inventory? The value of the inventory at the end of the year is 1,800,000. Madam, please, true or false?
Yes, please.
It is 1,800,000, right?
Yes, please.
I want to find it so that we can talk to it. Yes, the value of the inventory is 1,800,000. So next year, if you use that inventory, how you treat it?
1,800,000.
How you treat it? Let's say if you use it.
My opening stock will be 1,800,000.
So where will you send it to? I want how you treat it, how you recognize it. So where will you recognize it?
It will be under use of goods and services.
Perfect. Asa, that's the requirement. Explain how the subsequent consumption. So you tell them that subsequently you treat it as an expense in the goods and services if you should consume it. If you should consume it. If you don't consume it, then of course it will go to your, at the end of the year, if you've not consumed it at the end of the year, it will still go into your statement of financial position as current assets if you have not consumed it. But once you have consumed it, it will be on your expense. If I tell you here, then let's come to this requirement. So it's about the requirements. Are you okay? Come to this requirement. It's a B. Since you said you understand the I, right? So let's come to the B. Show how the consumption of these inventories will be reflected in the statement of financial performance for the year ended 31st December 2024. So here they are talking about all this amount relates to 2024. See, this is not subsequently. They said during 2024, these are the inventories bought. And 2024, this is the closing inventory. Are you okay? And they're asking you, how will you treat this in the statement of financial performance for the year ended 31st December 2024? For the year ended. So here it's not subsequently how you treat the closing stock. They're asking you how you treat the inventory that you incurred in the year. Madam, please, are you okay with that? So they're saying that, oh, for 2024,
Yes,
all the purchases, you add them together, then you less the closing stock. And all this should be in your goods and services. And they'll say you are correct. Madam, what you say?
yes, please.
Okay, good. So this brings us to the end of that particular aspect. Okay, good. So now I have another question here for you. All of you, start work. For this, the requirement is clear. Start work, all of you. So I want you to tell me, identify 4 situations in which the net realizable value or the current replacement cost of inventory is likely to be less than the cost. Under what circumstance would the net realizable value be less than the cost? The cost is supposed to be the same as the net realizable value. At what instance will the net realizable value be less, or the current amount be less than the? And the next one, calculate the correct closing value of the medical supplies. Calculate the correct closing value of the medical supply. What is the correct? Please don't do the I. Do the I because of time. Let's do the calculation. Calculate the correct closing value. Calculate the correct closing value. Start work. It's now 8:3. You are stopping at 8:5. Just calculate the correct closing value. That's all what I'm interested in. Okay, just the correct closing value. I just need the correct closing value. Start work.
So Steve, please pause the recording.
So, IPSAS 12, inventories. Prescribed accounting treatment for inventories. It provides guidance on the determination of cost and its subsequent recognition as an expense, including any write down to current replacement cost or net realizable value. Now, that's just a preamble. So let's the question. Ms. Ellen Addo, the Director of Finance at Ejiso Municipal Hospital, has raised a number of queries regarding the treatment of inventories under IPSAS 12. So she has an issue with the treatment of inventory under IPSAS 12. Continue. The hospital's closing inventory of medical supplies as at 31st December 2024 is 345,000. That's the closing inventory. Good. Continue. This amount includes 4,600 representing medicines that were accidentally destroyed on 31st December 2024. So this inventory was destroyed on 31st December, which is the same year. But still, they have included it as a closing inventory. Meanwhile, it has been destroyed. Pay attention. Continue. It says, after the stock count was completed. Good. 2,900 related to damaged medical items from October 2024. Are you okay? After the stock count was completed, another one, 2,900.
Hear anything?
You cannot hear anything.
We can hear you, sir.
We can hear you.
Madam, please check your network. Continue. It says that what? After the stock count was completed. Good. 2,900 relating to damaged medical items from October 2024. So these are damaged medical items. October 2024. These items can be re-wrecked at an additional cost of 600 and can then be used or sold for 2,400. Are you okay? Good. So you are asked that what? Calculate the correct closing value of the medical supplies. So it means the medical supplies is obviously wrong, right? So work the example, ICA. So that you can identify the type of question, okay? Let's make it Miss Ellen. Miss Ellen Addo. Good. So it says that what? Calculate the correct closing value of medical supplies. So let's calculate the correct closing value of medical supply. That is supposed to go to the statement of financial position. The value they have written is wrong. You and I know. Okay. Yes, so let's do it. Closing inventory from question. Closing inventory from question is how much? 3, 4, 5, 1,000. Less the medicine that were accidentally destroyed. Less destroyed. You have to let the destroyed medicines, right? Destroyed medicines. How much? Destroyed medicine. How much is the destroyed medicine? 4,600. Less it. Is that also? Now, when you finish lessing the destroyed medicines, it goes on to say that what? 2,900 relating to damaged medical items from October 2024. So they have damaged medical items, which costing 2,900. Are you okay? But it goes on to say that this item can be worked on at a cost of 600, then sold at a cost of what? 2,400. Are you okay? So let's pay attention here. So what is the name of this inventory? They said damaged medical item. So damaged medical item. Are you okay? So the total value of the damaged medical item, please, I'm doing something here. The total value of the damaged medical item is what? 2,900. Is that also? This is the value of the damaged medical item. Assuming they cannot work on it, assuming they cannot repair it, assuming they cannot repair it. Are you okay? This would have been the cost of the damaged medical item. This is what I would have deducted from the what? The closing inventory. Assuming they cannot do anything about it, and they said that damaged medical item is 2,900, I will have deducted this. But they said that, fortunately for us, this 2,900, they can what? They can sell it at 2,400, but they have to incur a cost of 600 on it. They can sell it at what? 2,400, but they have to incur a cost of what? 600 on it, meaning net realizable value of the inventory or the selling price of the inventory will become 2,400 minus the 600 repairs. Are you okay? So this becomes 1,800. Are you okay? Good. So you have a loss. You have incurred a loss of 1,100 on this. Anambwa. Yes, you have incurred a loss of 1,100 on this. Are you okay? So ladies and gentlemen, this becomes your closing inventory. The right closing inventory.
How about you?
I'm muting all of you in Jesus' name. Nonsense. Or I want him. Nonsense. Good. 339, 300. So this becomes the what? Correct closing inventory. So if you go and get this in ICAS, the students will be there and say that that's there's nothing, and yet they have given you a wrong closing inventory, and they say that, oh, chartered accountant, please find the correct closing inventory. That's all what they said. Are you okay? That's all what they said. That's all what they said. So in order for you to get a correct closing inventory, just deduct the destroyed medicine. If the medicine is destroyed, it's not available. So less it from it. Then also they said a medical item was damaged. Are you okay? Was damaged, and the value is 2,900. But the question goes ahead to say that if we should sell it, we'll get 2,400. But before you sell it, you have to repair it. So how much are you getting? The net selling price. How much are you getting? You are not getting 2,400. It's 2,400 minus the cost incurred in what? Repairing it. So you are getting this amount. So even though 2,900 is the damaged thing, less the 1,800 that you can collect from the damaged item, you can get this amount from the damaged item. So if I ask you what is the total amount of this medical item, you are going to lose only 1,100. Because even though the amount is 2,900, we will sell it for 1,800. So therefore, we are going to lose only 1,100. We are not going to lose the entire 2,900 because we will get 1,800. We will be able to salvage 1,800 from the 2,900. So the total loss to us is 1,100. Ladies and gentlemen, so how much should be accounted in a statement of financial performance? You will account for 3,000 as current assets because it is inventory, closing inventory, right? Maybe that is II or II. It says that was statement of financial performance. Please, how much will you account in a statement of financial performance? So in a statement of financial performance, you will account for bad debt. Is it bad debt? This is not bad debt, okay? You account for bad debt. It's not bad debt. This is not bad debt, okay? Destroyed commodity, destroyed inventory and all those things, okay? You treat it under goods and services. So you say you will account for the destroyed inventory as goods and services. Okay, that's where you account for it. You record it under goods and services. Okay, so therefore it will be destroyed. So under goods and services, you send it there. Destroyed medicine, 4,900. Then you have damaged medical item. Damaged medical item, how much? 1,100. So in total, what are you getting? 49 plus 4,900 plus 1,108. 60,000. Or 6,000. Yes. Someone saying their network. Okay, good. So I think that is the damage items, right? That damage items. Please, any question on this? Hey, 4,600, eh? Yeah, Tina, you're right. 4,600. The value is 4,600. The value is 4,600. Okay, it will go on goods and services. The destroyed commodity will go on goods and services. Okay, so that's it. Asa, you send it under goods and services, okay? The destroyed items, you treat it under goods and services to write it off. Are you okay? To write it off. This is the solution. Inventory written down to net realizable value is this. Total is this. Are you okay? Okay, good. Now, any question on this particular issue? Yes, Beatrice, your hand is up. Ask a question. Isaac, Nana, you will be next. Beatrice, go.
Yes, please. Does the statement destroyed after stock taking not affect the whole thing? Because earlier you said something about stocks are used based on they are recorded based on the day they were there's a word for it, I've forgotten.
Okay, good. But then do you understand before you go to that one, do you understand the calculation I did?
Not really, but I'll get it when I watch the video.
Oh, but then try and understand it here. I mean, there's nothing difficult about it. Why are you not understanding?
The part where so I was thinking maybe because the stock was taken after. So when you brought it down that we should take it out of it, I got it. Then you singled out the damaged medical items, and you also took that out of the 345,000. But you had to do some other workings on it. And then the NLV part I was lost because what you've taught us so far, you don't subtract anything. You either pick the lowest. No, you pick the lowest of any of the two items, and then you cross out one. But here you came to deduct something.
Madam,
So
it means madam, you are not trying to understand the concept. No, try to understand the concept too. Okay. No, try to understand the concept. This is a daily activity. Okay, it's a daily affair. Okay, don't be like, okay, fine, it is this, so it has to be this. That if not, and then if I see treat the thing issue small, no. Here it's talking about a closing stock that have been recorded wrongly. Are you okay? And based on your experiences so far, are you okay? They're asking that what you should correct it. You get it? So see, obviously, calculate the correct closing value. So they're asking you as a chartered accountant, you have recorded that, okay, fine. For a trade, 345,000 is the closing stock. And they are telling that the amount includes 4,600 representing medicine that were accidentally destroyed. You see, this is a medicine that was accidentally destroyed. And the question is that what? Call it the correct closing value. What I say? So this one, they are not talking about find the closing stock. How do you call it? Find the closing stock. It's the same as find the closing stock, though, but then it's not the normal one that will give you replacement cost and the net realizable value. It's not that one, because you cannot see replacement cost and the net realizable value here. Okay. Here they have given you the closing stock, and they said call it the correct closing value, because they know that you should be able to apply, your knowledge in accounting so far. Are you okay? So I'm saying that this one, you have to less 4,600, because that one, they said this amount includes 4,600 representing medicine that were accidentally what? Destroyed on 31st December. Okay, this amount includes 4,600 representing medicines that were accidentally what? Destroyed. Do you get it? It means that inventory has been destroyed. So why should they include it in the closing inventory? It should be your accountant, your issue. Okay, so they can be twisting the question here and there. Are you okay? That's why they gave you this preamble when they started. That's why they gave you this preamble when they started. Okay, because they know that indeed you are supposed to send the closing inventory to balance sheet. But what if there's issue with the closing stock? You should be able to adjust it. Then let's go. Also, I'm going to say, see, the amount includes 4,600 representing medicine that were accidentally destroyed on 31st December 2024. After the stock count. After the stock count, they destroyed an inventory. It will not change anything. They're just trying to explain why they destroyed the inventory. Please, you get it? Once the inventory was destroyed within the year, 31st December is still part of 2024. So therefore, this, you don't have to include this, because the inventory has been destroyed. So why should you include it so that your inventory will go high? You have to less it. They move on to the next one. They say that what? The next one says that what? After the stock was completed, good. They said 2,900 cedis relating to damaged medical items from October 2024. This item can be re-rec on 600. Okay, re-rec at 600, and can then be used or sold for 2,400. Are you okay? So I'm telling you that even though this is the spot or the damage inventory, this is not going to be the total cost to us. Are you okay? Because we can sell it at 2,400 after we have worked on it for 600. So subtract the 600 from the 2,400. So how much are you going to get if you should sell it? You are getting 1,800. So less than 1,800 from the this one, the 2,900, and you are the total, the net loss to you is 11,200. This net realizable value here is when you are selling, net realizable value, when you are selling this damage inventory, when you are selling it, you get 1,800. The reason I use net is because I subtracted the 600 from the 2,400. Are you okay? Net means that any cost incurred to sell the commodity, less it from the selling price. So you less it, and this is what you get. What it means is that this is the damage inventory. But if I should sell this damage inventory, I'll get 1,800. So in effect, how much have you lost? The loss will be 1,100, because I'm not going to lose the entire 2,900. Like this 4,600, I've lost the entire 2,600. But assuming they said that if I should sell the inventory that is the medicine that is destroyed for 4,600, if I should sell it, I'll get 3,000. Then my entire loss will not be 4,600, because I'll get 3,000. So you let the 3,000 for the 4,600, and your net loss will be 1,600, because you get something from the loss. Sometimes your fridge can get destroyed. You can go and sell the fridge and you get some small money from it. That small money, you can use it to reduce the cost. I mean, sometimes your car spoils. Okay, your car spoils. If you repair the car, you incur cost of 1,000. The sport part, you can sell it to Alumi and get 200 cedis. If I ask you how much have you incurred, you don't tell me you have incurred the cost of 1,000. No, this cost of 1,000, you have gotten 200 from it. Are you okay? So therefore, the cost you have incurred is actually 800 because when it's sold, the damage part, you got to 200 cedis. Less the 200 cedis from the cost. So your net cost or your net loss is 800 and not 1,000. The same way they said the damage part is 2,900. But then if this item can be reworked at additional cost of 600. So if you work on it, it's an additional cost of 600. And if you sell, you get 2,400. So 2,400, less the 600 from it. This actually how much I'm getting for selling it. I'm not getting 2,400 because I spent 600 to work on it. So I'm getting 1,800. This 1,800, use it to reduce your cost. But just as I say, use it to reduce your cost. So I subtracted it and I got this. Simple like that. Can you see that? Nothing difficult. We're nothing. So simple. Okay. So, madam, it's not like don't be static. Like sometimes the question can be so simple. So simple. Okay. But it's not always the case that you have to carry the closing stock and no. It's not always the case that they'll give you the trade. Sometimes you can give a simple question like you are seeing now. They give us just the closing stock. And they say you should find the correct closing stock. Okay. So the closing stock, any damage item be less it. That's all. And that's what we did. That's all. I'm giving the different ways the question can come. Are you okay? The different ways it can come. So that when you see it, you know that, okay, fine, this is talking about this. Okay, this is talking about just the closing stock. Oh, this is talking about this and that. That's why you could see that in all the three questions, there are different ways. Okay, thank you very much. So the next one says that what amount should be treated in a statement of financial performance? I'm saying that what the damage or the damage all should be treated in a statement of financial performance. Okay. So, madam, your issue that after this if it is after the year, that is where it will have an effect. If it is after the year, then that's when you have to ask if it is a adjusting event or non-adjusting event. Are you okay? If it is after the year, but here it's not after the year. All the accidents occurred in the year. Are you okay? Okay, thank you. So let's go on to the next. Nana, ask a question, please.
Yes, Mr. Steve. My question has to do with the treatment of the closing stock. I understand the portion whereby the damage costs and other ancillary expenses will be treated in the financial performance. But I am also of the view that the closing stock should also be deducted from the net expenses or the goods and services from the financial performance. If you write it that way, are you correct?
Okay, you are saying that this closing stock, it should also be deducted from goods and the statement of financial performance. Yes, sure. Yes, you are correct. You are correct. You are very correct. Because always the closing stock that is sent to the statement of financial position, we deduct it from the statement of financial performance. Is that also?
Yes.
Yes, under goods and services. Is that also?
Yes.
Yes, you are correct. So yes, indeed. So the corrected one, you have to go and reverse the one they used and pass this one instead. Is that the case?
Yes.
Is that the case, right?
Yes, that is the case.
You are correct.
Okay. Thank you.
You're welcome. Please, who else? Richmond, ask a question, please.
So thank you very much for the opportunity. Only just I want to get a clarification on how the damage item and destroyed medicines were treated in the financial position and financial performance.
Repeat what you said. You said you want to find out why or how.
Yes, so please can you hear me now?
Yeah, you said you wanted to find out why it was treated or how it was treated or.
I'm trying to say, can you elaborate more on how you have treated it? Like the way you were saying, we have to send the total of the damage goods and the destroyed goods to goods and services as expense. Can you elaborate on that?
Yes, so when you go to expenses, like the way you record any other expense, are you okay? Like the way you record any other expense, you go and record it there as well. Are you okay? Go and record it there as an expense. Do you get it? That's all.
So
So it's actually going to reduce your expenses because in the course of the year, these are the expenses you made, okay? And this one's no, it's going to reduce it. Are you okay? You send to goods and services.
yes.
Okay, thank you very much.
So assuming this is a full question we are solving, we are supposed to come and subtract these two amounts from the goods and services.
Of course, because it's going to reduce your expenses. Is that also? It's going to reduce your goods and services. And I'm a
okay, thank you.
Very well, thank you. It's like you have consumed it in that order. Good. Okay, good. So we go on. So please, because of time, let's proceed. Then I'll take the next batch of questions later. Go. So we are done with this. So simple. This brings us to the end of inventory. So some of the disclosure, please also know the measurement too, determination of the cost. Okay. So FIFO, weighted average, and specific identification. So please go through them. They're the same thing. I mean, I'm focused on the examinable areas. Good. Now, the disclosures. Okay. When you take any statement of financial performance or statement of financial position, in fact, when you take any financial statement, okay, you go to the note to account. When you go to note to account, they will explain how they treated the inventory. They will explain everything related to.
Sir,
Let me finish.
please.
Let me finish this.
First portion of the question, you said we will answer it. We didn't answer them.
Okay, good. The first portion of the question, it's in your this one. I'll give this note to you, okay? So with the reading, that's something that you go through it. Please, are you okay? They're asking you, why is the net realizable value not the same as the cost of the commodity? It could be due to the fiscal damage. It could be due to obsolescence. It could be due to decline in selling prices, increase in cost. So please, that one there. So with my kind. So then this is the solution. The solution is in the notes. So please understand them. This one you don't learn them, just understand it. Okay, good. Now let's go to the disclosures. So when you take any statement of financial position, statement of financial performance, when you take any financial statement, you go to the note to account. They will give us a breakdown, okay, of how they got the inventory, the accounting policy they used. Are you okay? The accounting policy they used. Do you get it? So the carrying amount of the inventory, they'll give you a breakdown. So these are some of the disclosures. Now, if they ask you, mention 5 disclosures of inventory, you can tell them the accounting policy, okay? You can tell them that what? The carrying amount of the inventory. Carrying amount of the inventory is measured. Amount of inventory recognized as an expense. Amount of inventory written down, okay, as an expense. Reversal of any written down value or carrying amount of inventory pledged as a security or liability. So please kindly take note. Okay, these are all disclosures. Learn any 3 of inventory. Learn any 3. Good, we are done. We are now with inventory. If you understood the inventory, give me a reaction. If you understood the inventory. Please, this one, the second question, there's general ICA issue. When they say it has no standard, though, they just want, they know you know. So they just want to find out something. The NRV you saw here, means that they are going to sell the damaged item. They are going to sell the damaged item. That's why I wrote NRV. It's not the NRV in the accounting standard. It's not the NRV in the accounting standard. So please, I beg you, well, don't make the thing difficult. So simple. Inventory is measured and lower of the this and that. That's the most important thing. That's the fundamental principle. Are you okay? Good. Okay, good. So we go. We go on to the next one. IPSAS 17 PP. IPSAS 17 PP. So simple. Who's at anything? So simple. So we are done with inventory. IPSAS stuff. We are done. We are go to PP. Okay. So let's go. PP. Now, Chiba, do you have a question for me? It seems your hand has been up and you're not dropping it.
Yes, sir. Please, it's on the inventory.
Okay.
From the question, yes. What if the question says that
maybe no work can be done on the damaged stock, yet it can be sold at 2,400.
Perfect. Then that one, it means that the net loss will not be 1 million. So it will be, the net loss will be, okay, we were supposed to incur a loss of 2,900. Are you okay? But then we can sell this item that is lost to us. No, we can sell it for 2,400. So please, it means the net loss will be how much? Shiba, give it to me. What will be the net loss?
500.
500. So instead of writing 1,100,000, no, you have to let only 500 from it. The budget is here. That's all. Okay, thank you.
But what if since the 2,400 is the net realizable value
from the sale of this net damage item, from the sale of the damage item? Are you okay?
Yes. If it is the net realizable value, and that the stock of the damaged stock is 2,900, and the net realizable value is 2,400, someone might just choose the 2,400 straight and deduct it.
Someone might just, then it will be wrong.
So I wanted that.
Look at something here. Look at something here. See, this is the item damaged. Are you okay? This item is damaged. 2,900. But if you saw this item, you are saying that you are getting 2,400. Is that also?
Yes, please.
That means that the total damage will not be 2,900 anymore. It will be 500. The total damage will be 500. So it is only 500 that you less from your closing inventory. Full stop. Please, are you okay? Please, the net realizable value, no. Bro, I'm the share on more. Bro, I could have made it selling. The selling price.
Okay, sir.
I could have made the selling price. Okay, this is not the net realizable value in the how to determine the cost of an inventory at the end of the year. That's not the net realizable value. Net realizable value is a general term. That means the selling price less the cost for sale. Are you okay? That's the term. It's a term. It's a terminology. Selling price less cost. Let me make it selling price less cost for sale. Less cost. So I get NRV. Okay, that because I'm subtracting this from that. So therefore, the net loss will be 1,100,000. So then let's get this. Thank you. So I think Shiba is now okay, and that is good. Good. So let's proceed. Now we can now come to PP. Let me end this video. Please, you are welcome to today's session of PSC. Today we are taking PP. PP. Now when we talk about PP is the same as the inventory. Just that the inventory is a short-term asset. Are you okay? It's a short-term asset. Inventory is a long-term asset. Are you okay? But the principles are the same. Are you okay? Good. When we talk about PP, every company uses an asset. Every company uses an asset, and every asset falls under what? PPE, unless assets that are for investment property and others. Okay? But basically, almost every tangible asset falls under what? PPE. Every tangible asset falls under what? PPE. Examples of PPE, nobody will ask you to define PPE, but then examples of PPE are building and other structures, transport equipment, furniture and fittings, machinery, infrastructure, assets, land. Are you okay? They are all examples of what? PPE. Are you okay? Good. Now, how do you recognize PPE in your books? At what point do you recognize an asset in your book? So let's say your boss has bought a new vehicle. Your boss has bought a new vehicle. At what point do you recognize it in your book? At what point do you recognize it in your book? Okay, that's the recognition of PPE. Ladies and gentlemen, you only recognize PPE if it is probable that the economic benefit related to the asset will come into the company. If it is possible that the economic benefit related to the asset will flow into the company. So what it means is that you don't have to own it. You shouldn't be the one to buy it with your money before you can call it a PPE. Or let's forget that one. That one is a bit technical. What I'm trying to say is that once you have the asset and the asset is flowing into your business, okay, the benefit of the asset, it's coming into your business. Are you okay? then you say that what? It is a PPE to you. The benefits. So you have a car. So if your boss buys a new car and tells you that you should record it, you have to ask yourself, your boss, one question. Boss, please, this vehicle, no, are you going to give it to your wife? Or is the company that's coming to use it? If you're going to give it to your wife, then I cannot record it as a PPE. Why? Because the benefit related to the vehicle will not come into the company. It will rather go to your wife. So therefore, it is not a PPE because the vehicle, when you're using it, it's not being used by the business. So therefore, the benefit related to the vehicle is not coming to the business. So therefore, I cannot record it as a PPE. I can only record it if the vehicle is being used in organization. So please, in order for you to recognize a PPE in your books, there should be probability that the future economic benefit will flow into the company and not elsewhere. 2, the cost of the PPE should be measured reliably. You should be able to measure the cost of the PPE. So you have to ask your boss, please, how much did you buy it? Can I see evidence, document? Okay, the cost of the PPE should be measured reliably. So this is the recognition criteria for a PPE. The cost should be measured reliably, and also the future economic benefit should flow to the company. The future economic benefit should flow to the company. Okay, good. Let's proceed. Initial recognition. Yes. Elijah, ask a question, quick one.
Hello,
Please,
sir.
Yes, please.
Sir, can you hear me?
Loud
so,
and
sir,
clear.
Please, now, asset has to do with control, but not ownership, right?
Exactly.
Okay, thank you.
Yes. So
because we're taught in essence that own and control.
It's supposed to be control. You don't have to own it. That's why I said it's a bit technical. You don't need that one. Are you okay? You don't have to own it. You can own it and it will not come into your. In fact, sometimes you can even have an asset that you don't own, but you are enjoying the future economic benefits of the asset. It is there. It is there. You don't own it. You didn't buy it, but you are enjoying the future economic benefits. The benefit of that asset is flowing into. Yes, the benefit is flowing into your company, even though you didn't buy it. Are you okay? The cost should be measured reliably. Thank you so much for the word. So sweet. Now, measurement of PPE. Measurement of PPE. Measurement of PPE. How do you measure PPE? Ladies and gentlemen, there are 2 ways, or there are 2 steps here. We have the initial measurement, and we have subsequent measurements. Are you okay? Now, when you buy a new asset, you buy a new asset fresh. How do you measure it in your books? What amount do you put in the book? You measure it at cost. True of course. So please, the initial measurement is always at cost. When you buy a new asset or when you build up an asset, you build up a factory. What value do you put in your book? The value you put in your book is the cost of that asset. Or if you should go and buy a car, an already made asset, the value that you put in your book is what? Is the cost. So initial measurement of PPE, ladies and gentlemen, what I'm trying to say is that if you are in a company, and the company say buys a machine, are you okay? What value or how do you measure it? What value do you put in your books? How much do you put in your books? And I'm saying that you put the cost at which we bought that machine. It's common sense, right? The cost, because that's the first time you have bought it. Because that one, you have supporting document. That tells you that, oh, this machine was bought for 550,000 euros. So initial measurement, we put the what? We put the cost as the what? Initial measurement. Initial measurement is the cost of the item. So initial measurement is cost. Are you okay? Now, what makes the cost? Is it how much we bought it in Kwan? Is it the purchase price alone? No, it's not just the purchase price. It is the purchase price plus all other directly attributable cost. Okay, so we have the purchase price include the import duty, non-refundable purchase taxes, trade discounts, rebates. Okay, all these are what cost. Are you okay? Now, if you see VAT, if you see VAT, no, that one is not okay. That one, no, they won't say VAT is not. I mean, you definitely claim it. You take it as an input tax. So that one idea, it's refundable. So don't. Are you okay? But in case they say you put VAT. Once the VAT idea, you don't add it to the cost. Are you okay? Unless the levies, you see the levies, those levies needed, you add it to the cost because that one you cannot collect it back. True of us. You cannot go and claim the levies as an input. But the VAT needed, you claim it. So that one idea. Are you okay? But then if you see any taxes in an exams, I'm saying this based on the question that Mr. Joseph asked. If you see any taxes, they say this tax, they are add all tax to the cost. Add all tax to the cost. Are you okay? With the exception of VAT. VAT, you claim it. How do you treat VAT in your campaign? You don't add it to the cost of the assets. Huh? You expense it. Is that also? Maybe you expense it. You treat it separately because you are going to what claim it. Are you okay? But if it is levies, that's one you add it to the cost of the assets. True of us. True. Okay. So purchase price includes the import duty, all taxes, all non-refundable taxes, trade discount. Repeat. Discount is when they give you discount, you less the discount from the cost. So if the asset is costing 20,000 and you are giving a discount of 10%, so you less the 2,000, which is the discount, okay? So that you get what 18,000 to be the cost of the asset or the purchase price of the asset, okay? And all other attributable costs like employee benefit directly arising from acquiring or constructing the assets, okay? That's labor. If somebody constructed the assets, maybe you constructed the asset, you didn't buy it, but rather you constructed it, the factory, you constructed the factory, okay? All labor cost, are you okay? All labor cost. Cost of site preparation, the cost of preparing the site, okay? Initial delivery, delivery of the raw materials and anything that we're using to do the building, okay? Installation cost, assembling, testing cost, are you okay? Testing to ensure asset operates as intended. Professional fees, do you know professional fees? Architects, consultants, all these are part of the cost of the assets because it's because of the asset. That's why you employ the consultant. Are you okay? All this testing cost. It also includes the present value of estimated dismantling cost. The present value of estimated dismantling cost. Are you okay? The present value of dismantling. Maybe you are installing a machine which you will remove in 10 years' time. Are you okay? Now, how much will it cost you to remove in 10 years' time? So you have to find the present value of that future amount. The present value of that future amount. Are you okay? So the present value of the 10 million. So that you can put it as part of the cost. So you can put it as part of the cost. Okay. As time goes on, you'll be unwinding it. You'll be unwinding the discount rate. Okay, you'll be unwinding it, and we'll do all those things. Good. So these are the cost elements of the cost. Are you okay? Remember, it does not include the cost of a PPE. Does not include cost of introducing a new product, cost of commissioning a new facility, operating losses, interest on deferred payments, training costs, except when the cost is inseparable. Training cost, except when it is inseparable from the PPE. There are certain assets that without training, you cannot use it. That one idea, it should be part of the cost of the asset. But then if it is separable, if you see training alone, please don't include it. Unless they state categorically that the training cost is inseparable from the PPE. That one, they add it to the cost of the PPE. By the way, you just go and see training cost, they ignore it. Don't add it to the cost of the PPE. Are you okay? They say training cost should not be part unless it is inseparable. Unless it is what? Except when it is what? Inseparable from the PPE. And the last one, general expenses, general administrative expenses, general administrative. Ladies and gentlemen, these are all expenses that you don't include to the cost of the assets. Per what I just said, and because I know you respect, follow my guidance and do this assignment, do this exercise. Illustration 1, 1 minute, start work. Illustration 1, 1 minute, start work. So we do it. Let's go. Oria Metropolitan. Okay. Oria Metropolitan. Oria Metropolitan is installing a new plant at its production facility. It has incurred the following cost. Oh, sorry. Let me indicate. so that it will be easier for you to PP. Okay, Oria. Oria Metropolitan. Okay, so cost. Initial delivery and handling. Okay. Cost of site preparation. Consultant. Interest charges paid to the supplier of plant for deferred credit. No. Present value of estimated dismantling cost. Okay, so dismantling. Remember, they've given the present value. This is a present value, so this is the present value. So you can write it boldly. Last one, operational losses. No. Answer. Answer. I see
8,600.
Thank you. I think this is simple. Elijah, do you have a question?
Yes, sir.
Ask a question, please.
So, with what to capitalize and what not to capitalize. Maybe you bought a plant that you are going to use for production. So in the course of testing, maybe you produce some of the products that we can sell. After selling those products, the income, how do you treat that income? Thank you.
You less it. You've not started.
Okay.
You've not started operations. Is that the case?
Yes, you've not started operation.
You
Maybe
less
just
it.
the testing.
You less it.
Okay.
You less it.
Okay. Thank you.
You're welcome.
Okay.
Okay, we go to the second question. Please, the second question is the same. Can you see that? Just that the only difference is that they said that what estimated dismantling cost to be incurred after 10 years. So this is the how do you call it? So let's do it. Adenta municipal. Adenta municipal. So you have cost. Some of you can be doing it too. So cost of plant, the same thing. Initial delivery, so delivery. Cost of site preparation. We have consultant. Consultants are professional charges, right? We have interest charge. Interest charges paid to supplier. No. For deferred credits, no. Estimated dismantling cost. They didn't give us the present value. They just said estimated dismantling cost. So dismantling cost. They didn't give us the present value. Continue. He says that what? Operational losses. Now, assume discount rate is 5%. Discount rate is 5%. So we have to do it 1 plus R raised to the power negative n. Are you okay? I'm just teaching you. So therefore, that's how to get the present value, the discount factor, right? So 1 plus the R, which is 5%. Is that also 0.05? Raised to the power, the number of years, 10 years. times the amount, 600,000. Or let me just say 600, okay, because you are working in thousands. So 600. Please don't answer. So dismantling cost. Answer. On your calculator, punch everything. 1.05 raised upon negative 10 times what? 600. Answer. 368. Is that the case?
Yeah.
Ladies and gentlemen, this brings us.
0.35.
Okay, let me ignore that. Yes, final answer, please. Or let me put it. 0.35. Final answer, please. Oh, mention it.
1168.35.
1168.35. Okay, thank you. We go to the next one. Do this. Do you know a question like this came in the exams? Last two nights, a question like this. And a borrowing cost. Start work. Follow the principles. Start work. I wasn't recording. As a result of the as a result of the problems above, the building sealed for fortnight during October 2018, and it is estimated that approximately 9 million of the labor cost relate to this period. So that's 9 million relates to this period. The period that the building seized, 9 million relates to that period. So therefore, not the entire 150,000 relates to labor. Some relates to the period that the building seized. So 150 minus 9. Are you okay? Please, what do you get? You get 141. Anambwa. Okay. You have the next one, architect fees. You see how they can put the question? They'll bring a small footnote here to change one or two things. So you have to read to understand. You should be in control. Architect fees, 20,000. So the total, somebody said it is 519. If I write it, don't tell me. So this is the cost of the building. So this is the cost that they put in the building. So they write building costing 519,000. So this is the cost of the building. Ladies and gentlemen, Agbena, that's it. Yes. So Chief, can you ask a question? Please unmute yourself. Please try and unmute yourself.
Hello.
Yes, please. I'm with you.
I'm saying that with regards to the footnote, assuming you go ahead to bring the 100,000 for the material cost, then you go to the footnotes and then bring the 15,000 and the 9,000 as another
deduction
into bracket. Yeah, into bracket.
Yes.
That way, will it be more correct? And would that
Please,
give you
correct.
additional marks?
It's very correct.
And would that
but you not get additional marks. No, you not get additional marks, but then you get it correct. Okay. Yes. So, like our brother is asking whether if you could go ahead and enter the 100,000, then later come and deduct the 10 and 15,000 as a line item. And I'm saying it's correct. Are you okay? It's very correct. Very correct. Okay, good. So that's that. We are done. Now let's go to the next one. Do you want to try or I should do it? Okay, try. I know some of you want to try. So let's. So please, again, give me the total answer. If you give me wrong answer, I'll not change it. Total answer, please. Mention or chat box. Please, chat box. Say it's correct. Oh, someone says correct too. You see what you are doing to me? Okay, then I'm done. If it says correct, then fine. Okay, let's proceed. Francis, please off your video. Mr. Francis, kindly off your video. Thank you. So please, this one, GRA. Okay, so it's simple. What is the cost of the assets and what is the annual charges in the statement of financial performance? So they ask what is the cost and what is the what? Depreciation. Annual charges the depreciation. Consumption of fixed capital. Are you okay? So let's go. It says on January 1st, 2016, GRA acquired production equipment in the amount of 250,000. The following further costs were incurred. Delivery, 18, installation, 24,500, general administrative cost and indirect nature, of an indirect nature, general administrative cost of is 3,000. Okay, so quickly, before I even go to the footnote, quickly. Oh, let me go to the footnote. Footnote, it says, the installation and setting up period took 3 months, and further amount of 21,000 were spent on cost directly related to bringing the asset to its working condition. Are you okay? That is what? Installation and setting up period took 3 months, and a further amount of 21,000 were spent on cost directly related to bringing the asset to its working condition. Okay. The equipment was ready for use on 1st April 2016. The equipment was ready for use on 1st April 2016. Monthly managerial report indicated that for the first 5 months, the production quantities from the equipment resulted in an initial operating loss of 15,000. Initial operating loss of 15,000 costs because of small quantities produced. The months thereafter show much more positive results. The equipment has an estimated useful life of 14 years. The equipment has estimated useful life of 14 years and a residual value of 18,000. Estimated dismantling cost amounted to 12,500. A relevant annual discount rate. Annual discount rate to use in any discounting is 10%. Discount rate. You know discount rate? That is what you use to find a what? The present value. The discount rate is what you use to find a what? The present value. Are you okay? You know discounting, right? So please, let's go. So here, the cost. Calculate the cost of the asset. So cost of assets. So we have the first one. What is the first one? They said GRA acquired a production equipment. So cost of production equipment. Cost of purchase. This is how much you purchase it. How much? 250,000. Now delivery, 18,000. Delivery. Okay, delivering the asset to the company is 18,000. Installation. So cost of installing is how much? 24,500. Now, general administrative expenses. Ladies and gentlemen, we do not record general administrative expenses. So we don't record it. Continue. The installation and setting up cost took 3 months and a further amount of 21,000 were spent, okay, on the cost directly related to bringing the asset to its working condition. So that's one we what? Other cost. Other cost. Other cost will be 21,000. Are you okay? Other cost is 21,000. Proceed. Now, they said a monthly managerial report indicated that for the first 5 months, the production quantities from the equipment resulted in an initial operating loss of 15,000. Ladies and gentlemen, 15,000 operating loss, you don't record it. Are you okay? You don't record it. Good, because of small quantity produced. The months thereafter show much more positive results. The equipment has an estimated useful life of 14 years. Estimated dismantling cost. Okay, so dismantling cost. Remember, you say you have to write the present value, dismantling cost. Okay, The present value of dismantling cost. So dismantling cost is what? 25,000, right? Or 12,500. A relevant annual discount rate of what? 10%. They always give you the discount rate. They always give you the discount rate. So it will be 1.1. How many years? 14 years. 14 years. Okay, the equipment has an estimated useful life of 14 years. So it means it's after 14 years that they will dismantle it. Because that's the end of the year. It's at the end of the year that they'll dismantle it. That's 14 years. At the end of its useful life, that's when they'll dismantle it, right? So it is 1 plus R. The R is 10%. So it is 1 plus 0.1. Are you okay? That's why I got 1.1. You get it? Raise the power negative n. That's it. Raise the power negative 14. It's the same as 1 plus R plus R. 1 plus 1 plus R. It's the same thing as this. Raise the power n. Are you okay? So when you remove this, they make this one negative. That's why you got this. Are you okay? So please. Times the what? The future value, or times the future value, get a present value. Okay, this 12,500 is how much it will cost us in 14 years. So when you multiply, what do you get? So you get 3291. So when you add, or you get 316,792. Let's see those who got it. Who got it? Okay, good. Kofi Mante got it correct. Who else? Okay, good. So that's all. That's all. Ladies and gentlemen, this brings us to the end of the initial recognition. This is initial, okay? When you buy the asset fresh, you recognize it based on how much it costs you. That initial recognition. Initial recognition. So as you can see, do the initial recognition. Okay. We have another one called. So please try some. Try some. Do some. So do try one. This one is an assignment. Do it. Try work 2. Do it. Try work 3. Do it. For your discussions. Are you okay? Good. That's that. Now, exchange of assets. Sometimes you will not go and buy the asset with your money. Sometimes you will not go and buy the asset with your money. So for you to recognize the cost, okay? That is the purchase price, less discount, and all those things. You do not. Sometimes somebody can dash, okay? Some can gift the asset to you. Sometimes somebody can gift the asset to you. When someone gifts the asset to you, or when someone dashes the asset to you, okay, the value of the asset becomes the fair market price. Okay, becomes the fair market price. Okay, you have to know the fair value of the asset. Sometimes too, you will not be gifted with the assets, but then you see, this is public sector. Public sector, sometimes they exchange assets. GRA will be having a van that they don't need. Are you okay? Meanwhile, GRA needs a computer. And how do you call it? Temayo Refinery also needs a van, and they don't need their computer. So they can do exchange, whereby GRA will give their van to Tor, and Tor will also give their computer to GRA. Are you okay? They can do that exchange. If it happens this way, what value do we put in our books? What value do we put in our books? So this is the order of cost determination. The order of cost determination. 1, it should be the fair value of the assets given up. So you, GRA, giving your assets, that's a vehicle to Tor. The value for the computer you are receiving from Tor should be the value of the car you give out. Okay, so this is how to determine the cost of an exchange asset. The cost of an exchange asset. The cost of an exchange asset. When you get assets free of charge, you should use the fair market value. When you exchange an asset with a different entity, okay, the cost you should recognize in your book should be the fair value of the asset that you gave up. Fair value of the asset you gave up. That's the first thing. If the fair value of the asset you gave up cannot be found, it's difficult for you to get the fair value of the asset you gave up. Then you can use the fair value of the assets you are receiving. Then you can use the fair value of the assets you are receiving for the value of the assets that you have collected. You get it? You can use the fair value of the assets you are receiving for the value of the assets you have collected. Or you can use the first instance is that use the fair value of the asset you gave up for the asset you have received. That will be the value of the assets in the book. This is a standard though. Second process say that what? If the fair value of the asset you gave up cannot be found, then use the fair value of the asset you receive for the value in your book. And the third step say that what? Use the current amount of the asset you gave up. The value of the asset in your book before you exchange it. Use that value for the asset you have received from an exchange transaction. So in an exchange transaction, okay, when you exchange a transaction, the value that you keep in your book, let's say GRA has a vehicle, so Temayo Refinery has a computer. They have exchanged it. Now, when they exchange it, now GRA is now having a computer. And I'm asking you, since they exchanged it and GRA didn't buy for it, didn't buy the computer, how much should GRA put that the computer is having in their books? In the books of GRA, how much should GRA cost the computer? Since they didn't buy it with their money, how much should they cost the computer? And the principle is saying that what? One, use the fair value of the assets. Fair value of it's an exchange of the assets. An asset may be acquired in exchange for another asset. The cost of such assets is measured at its fair value. The cost is measured at its fair value, unless the cost is measured at its fair value, unless the cost of such assets is measured at fair value, unless the exchange transaction lacks commercial substance. Unless the exchange transaction lacks commercial substance. When it is difficult for you to know the value, it's very difficult for you to know the value. If it lacks commercial substance, or the fair value cannot be measured reliably, if it's difficult for you to measure the fair value of that asset reliably, then this is what you do. You use the fair value of the asset you gave up. So GRA will use the fair value of the asset they gave, the fair value of the van, to be the value of the computer in their books. Unless they can easily find the fair value of the computer in the market. Unless GRA can easily find the fair value of the computer. If GRA can easily find the fair value of the computer, then they should use the fair value of the computer in their books. But if it's difficult for them to find the fair value of the computer, then they should use the fair value of the assets that they gave up. The asset that they gave up, down they know the fair value of the van. So they can say that, oh, the computer is costing $90,000 because that's the fair value of the computer. If they find it difficult to find the fair value of the computer, then they can use the fair value of the van that they gave up. Two, fair value of the asset you received. The asset you received, no? What's the fair value of the assets? And then lastly, the carrying amount of the assets given up. The carrying amount of the assets given up. Are you okay? So good. So this is how to treat an exchange assets. Exchange of assets. Exchange of assets. This is the public sector. Are you okay? You have an example. An example is that Paul exchange a motor vehicle with a carrying amount of 21 million. Paul, the Temayo Refinery, exchange a vehicle with a carrying amount. Carrying amount means the value of the assets as at the time that they were exchanging it. The value of the assets as at the time that they were exchanging it. So Paul exchanged a motor vehicle with a carrying value of 21 million. And the fair value is what? 26 million. The fair value is 26 million. In addition, S&D, no, it's supposed to be Thor. In addition, Thor also paid a cash amount of 1.5 million. Ladies and gentlemen, see, it says, note, in situation where additional cash is paid, along with assets acquired in exchange. In addition, in situation where additional cash is paid, along with the assets acquired in exchange, it will be added to the fair value of to arrive at the cost of the assets. It will be added to the fair value to arrive at the cost of the assets. In a situation whereby cash is paid along with the assets acquired in exchange, it will be added to the fair value. Are you okay? So please, ladies and gentlemen, so Thor exchanged a motor vehicle with a carrying amount of 21 million. And the fair value of the vehicle is what? 26 million for a plant. In addition, Thor also paid a cash amount of 1 million, 1.5 million required. Calculate the initial cost of the motor vehicle. Calculate the initial cost of the motor vehicle. So the principle says that what? First of all, the motor vehicle that they exchanged, are you okay? They should use the fair value. No, you do it. Please do this before I explain. This is top. Top. Good. So please try this. 1 minute, 1 minute. So exchange, this one is 1 minute. Okay, so let's do it. So now please pay attention. Now, Thor exchanged a motor vehicle with a current value of 21 million and a fair value of 26 million for plant. In addition, Thor Limited also paid a cash amount of 1.5 million. Calculate the initial cost of the motor vehicle received. Calculate the motor vehicle cost of the motor vehicle. Is that the fair value? The cost will be the fair value of the motor vehicle. When you exchange a vehicle, you record the what? The market, there's how they call the fair value of the vehicle. Are you okay? You record the fair value. If you paid any cash, add the cash. So it's the fair value plus the cash. That would be the value of the assets in your books. That would be the value of the assets in your books. Not how much it's the value of the assets in their books. So now the fair value is equal to what? The cost of the asset is equal to what? The fair value plus the cash paid plus the cash paid. Fair value plus the cash paid. Are you okay? Good. So we take another one. S&D Limited exchange a forklift truck, okay, for a motor vehicle. So they exchange a forklift for a motor vehicle. On the date of the exchange, the forklift truck has a carrying value of 20,000. Okay, on the date of the exchange, the forklift has a carrying amount of 20,000. The value of the forklift was 20,000 on the day of the exchange. Continue. And an accumulated depreciation of 40,000. Accumulated depreciation of what? 40,000. The fair value of the forklift was 15,000. The fair value of the forklift was 15,000. In addition to giving up the forklift, S&D Limited also paid 3,000. Now, calculate the initial cost of the motor vehicle. The initial cost of the motor vehicle is always the fair value. Like I said, always the fair value. Plus, if they paid any cash, add the cash. So they pay cash of 3,000. So the fair value of the fair value plus the what? The cash paid. That will give her the cost of the motor vehicle. In an exchange of assets, you only use the what? The fair value. Unless if the fair value cannot be defined, then you use the fair value of the asset given up. And the asset that you are giving up, you can use its value. It's always fair value and never the carrying value. It only becomes the carrying amount if you are not able to find the carrying value of the asset 1, 2, the carrying value of the assets that you gave up. Are you okay? Or that's when you use the carrying amount. Are you okay? Good. So that's that. Good. Any question on this so far? Yes, Elijah, please unmute yourself.
Hello, sir.
Big man.
Sir, please, the other question. We saw one question before this one where there was a delivery cost.
Delivery cost.
They gave us a delivery cost.
What about delivery?
Yes. So this question. So assuming that the delivery was free, and then maybe we can find a fair value of the delivery cost. Should we add it to it?
You don't have to
Or
add
what
it.
do we do?
You don't have to add it. It's not a cost. It's not
as
a
a
cost you have
discount.
incurred. It's not a cost you have incurred. Are you okay?
Okay.
It's like if the delivery was free, then it means that the delivery cost has been factored in the cost of the assets.
Okay.
So you don't have to add the fair value of the no. We want the true cost of the assets. Are you okay?
Okay.
A very
Thank
good
you.
question. But then do you understand the exchange?
Yes, please.
I said if you receive an asset through exchange, use the fair value. If you paid any cash, add the cash. Are you okay? If it's difficult for them to find the fair value, that's when you use the carrying value of the assets, okay, or carrying amount of the assets. It's as simple as that. Fair value, if you paid any cash, add the cash. Thank you very much for the way so sweet. Ladies and gentlemen, when we meet on Sunday, we will continue with subsequent measurements and what? We'll continue with subsequent measurements and we'll now do investment property when we meet on God willing Sunday. Are you okay? But then, as it stands now, I'm giving you some assignment. Try work 3, try work 2, try work 1. Are you okay? Do all of them. Are you okay? Thank you very much for the way so sweet. Say this one. Can you unmute yourself?
All right. Good evening.
Good
Hey,
evening,
I
big man.
really, I really enjoyed the class. Class, you are so fortunate to have a fantastic facilitator like Sir Steve. You all know that when we talk of public sector, no size, the whole Ghana. Okay, this is
Yes.
just by the way. Please, we are pleading with all of you who, in one way or the other, there are some small outstandings that you are to meet. I'm saying this because there are significant number of students who are still indebted with the institute. We are a family, and then you know that we do everything flexible, and then for life to be simple for
Please, we've not
everyone.
closed.
But
Sedesmond, please, 1 second. Please, we've not closed. Though. No one should go. Okay. No one should go. No one should go, please. Okay, Sedesmond, please.
it's like the leniency. I don't know how you people are taking it. So we still have some significant number of students who are still owing. Look at the delivery that you are having this. Stevie is having a wife, a kid. By this time, he's so passionate to let you pass. At least the motivation alone. At least you have to at least appreciate the effort. It is this same amount, 450 cedis for 3 good months. If you divide it by 3, how much are you paying per month? How much are you paying per month? That you need to do. So please, we are urging everyone that are owing to kindly honor their obligation. Now, salaries for September, by next week, every salary will be paid. So I beg you, say Steve, please encourage your students. You know your students, you have the largest number, and then they are owing. So please, in as much as they are enjoying the class, kindly encourage them to pay. We pay this thing. We have other huge fees costs that we meet on monthly basis. This Zoom that we do, we pay in dollars. So please, we beg you. We are on our knee begging you that if you want the institute to grow and your next generation to come and benefit, please kindly pay whatever is due us. So, Sir Steve, I beg you, that is the more reason why, we discussed this thing over this thing, and then the challenges we are facing. So at least we need the money at the end of the month in order to do some other, to cover other overhead. So please encourage your students to just do the needful. Thank you.
Well, thank you so much. So I'm recording this so that those who couldn't join the class can also benefit from this very announcement. So I can now end this one, the recording. Please, I'm begging you. See. Let me tell you something. You joining SMD, it has relieved you from buying the ICA manual. You can rely on our manual and you still pass. In fact, you can rely on our lecture notes and you pass. You understand it? When you go to other institutions, I keep saying this. When you go to other institutions, okay, they're interested in selling you a book. It's one thing you do first. You have to buy a book. If you don't even buy it, they will tell you that without you buying it, you can never pass. At S&D, we are even giving you learning materials and almost everything. Look at the dawn class we do. Are you okay? Look at the dawn class we do. I'm pleading with you. It's just 450 cedis. Like Desmond said, divided by 3. So please, if you are owing here, sometimes I feel bad in saying it hurts. I know you do the needful, so I'll not talk much. I'm begging you. S&D, PSA, 86 students are owing. 86. I mean, that is those who are owing above 100. Some are owing less than 50, 60. Those ones, I didn't include them. I'm begging you, please. I don't want to call you over this, and it will be as if no. Please, whether you are going to write the exams or not, you make it in Obichem 2000 last 2 days to save, last 3 days save. Are you okay? If you pass, what you can do, what can't you do if you pass? You do so many things and even beyond. I beg you, just pay. It will be very painful for you to go and register for a paper for close to 1,000 cedis. And the teacher that taught you for the past 3 months, just paying, it's painful. Please, we are begging you. I'm begging you. I'm begging you. Okay, thank you very much. So now let's proceed. Please, the IPSAS note will be shared. Are you okay? Those doing financial reporting, you realize that it's the same thing that you'll be doing in financial reporting. The same thing. Those who did financial reporting in the various universities, you realize that it's the same thing. Are you okay? Those who have never done financial reporting before, those who have never done IPSAS before, those who have never done IFRS before, I believe you are following. Are you okay? You are following. It's nothing difficult, right? Good. So don't worry. We'll continue, God willing, Sunday, right? Perfect. So then let's begin with our briefing, please.